Hi, today we have Browne, our Head of Asset Allocation Asia. He's going to be sharing with us how he thinks about the market in 2023 and what investors should look out for in 2023. Luke, how are you?
I'm good, thank you, Grace.
Yeah, 2022 wasn't a bond year, nor was it a year for equities. So we continue to see retail locking up their idle capital, meaning cash, in fixed deposits or money market funds in a rising rate environment. What are some underlying macro dynamics that are driving this?
Yeah, I think talking about 2022 is important. Obviously, we've seen an enormous reversal both in terms of central bank policy. We no longer have zero interest rates, and of course that's had a material effect on the bond markets. We all understand that there's an inverse relationship between yields and prices. The second part, of course, is because of this change of policy, because of persistent and high inflation, risk assets generally have fallen in value. Now, that's obviously caused a lot of concern for investors who, over the past decade, I think, have enjoyed outsized returns just from holding beta. And quite often in single asset classes in order to achieve their investment objectives. But I think looking forward, we have to be a lot more thoughtful about where we're positioning and what risks we're willing to take in order to meet our financial goals.
Yeah, absolutely. There's no cheap money anymore.
There isn't. And, you know, you made the point about the flow of money that we see going into deposit rates. And the reality is cash is back. Okay, in US dollars, if we can receive between 4 and 5%, and I'm sure we'll talk about this, arguably that's going to be higher, it becomes a much more relevant proposition. The only sort of cautionary tale I would give to investors thinking about that is not only do you need to think about the cash rate that you're receiving, but also the inflation rate. Because inflation, of course, as we know, erodes your wealth, your value over periods of time. And if your cash rates are below inflation, which broadly across the world they are, then whilst the cash rate in absolute terms looks very attractive relative to recent history, it is going to erode your capital.
Exactly. I think a lot of the younger generation hasn't seen an inflationary environment, and then and it has a pretty big impact on your wealth going forward if you're looking into retirement, 10 years time, 15 years time. Now, on that point, what approach should investors take to capture income and also navigate, the uncertainty of whether it's a soft landing or hard landing? So how would you position the portfolio going forward to help investors navigate that?
Yeah, so my approach and my beliefs around income investing is that we need to approach it to maximize the probability of delivering that outcome that clients are looking for. Now, in order to do that, I want to make sure that when we construct portfolios, we have a diversified set of return drivers. And what do I mean by that? I don't want to have a portfolio where the outcome is going to be dominated by a particular position, a particular factor, a particular risk, whether it's in broad asset classes or even boiling down into individual sectors or themes that we see in the market. So certainly I do think a diversified approach where you can source your income streams from a number of return drivers is appropriate. Now, in terms of hard landing, soft landing, I even heard no landing being talked about at all. As far as I'm concerned, planes always land, so no landing is off the table. I think inflation is persisting and proving stickier, and there's a lot of macro factors that can further influence that, including China reopening, which I'm sure that we'll talk about. So there's lots of moving parts, lots of dynamics that we need to consider. There are, of course, opportunities, and having a persistent and consistent delivery of income is still achievable. Fixed income as an asset class, of course, has become more attractive because nominal rates are higher. Credit spreads in certain segments, I think, still offer an attractive opportunity. And then, of course, within equities, there has been a degree of resilience in earnings so far. I do have concerns that those might start rolling over more than we have seen. I think margins could become compressed as central bank policy continues to pursue demand destruction effectively. So lots of moving parts, very achievable, but my approach is focus on the outcome, have diversification.
Exactly. So I think when income investors, when they're looking at what kind of investment strategies they're looking for, the key is that, be mindful of the risk, especially there's still a lot of macro factors at play. So not a fully risk-on situation right now, and then they should stick with a more balanced approach, more diversified approach to navigate in 2023. I think that's the key message.
Yeah, that's exactly right. And for me as well, and what I always try and explain to clients is that, constructing these portfolios, even with diversification, we have to take market risk to get the returns they're looking for. So there is risk in the portfolio. But let's understand the journey and the destination. And what are we trying to do in the way we manage money for clients is navigate those changing market conditions. We are trying to avoid the troughs and we're trying to capture the peaks. Now, we don't do it perfectly. I don't think anybody would claim to be able to do so. But it is navigating those episodes, having a robust process that you follow, and getting involved in the opportunities that you have high conviction in.
Great, thank you. Now, back to Asia, talking about diversification. Now, the global growth outlook can still be challenging. We talked about Europe. It's still very challenging in Europe. And on the other hand, we have China's reopening, gaining momentum. So how do you think about Asia?
Yeah, I think maybe before I talk about Asia, because you mentioned Europe, you're absolutely right. Europe has a whole series of challenges. In the press, we're all aware of the ongoing difficulties, conflict between Russia and Ukraine, and how that is going to evolve. And this has had dramatic impacts, particularly in energy, as we know. Russia being an enormous supplier of natural gas and oil, certainly to the European market. Now, moving across and looking at Asia, I think, if we look at the data that we see, and we even saw the Korean Central Bank come out today and hold rates, which was predicted by the market, but that has been a change in view over the past few weeks. And the reason is they are getting to the end of their tightening cycle. I think Asia has avoided much of the sort of cost push inflation that you've seen in the more Western economies, so Europe and the US in particular. Part of that has, of course, been driven by China still following COVID restrictions. But then, as you say, we've now had a shift in policy, opening up. I think that has led to outperformance, certainly in Chinese and Hong Kong equities, and rightly so, because that's been quite a euphoric view, I think, for the markets, and explains that. What I see, however, is that the effects of China reopening haven't yet fed through. And what do I mean by that? Well, consumer spending still has to feed through into the economy. And so I think, yes, we've seen the reopening, and this has been the catalyst, if you will. But as the spending continues from consumers, I think this is actually going to drive growth in China and the broader Asian market, and I think does offer potentially more attractive allocations when you think of a globally diversified portfolio.
So, one more question. US dollar. Is it a weakness? Is it a strength? What do you think? How is it going to impact Asia?
Okay, so let's talk about the US dollar first of all. Now, in Q4 of last year, and if anybody sort of reviews my musings that have been out in the market, one of my conviction trades for 2023 was dollar weakness. That was reflected in some of our portfolios where we could take those positions, and we did see a material weakening in the US dollar versus the rest of the world. What we're now seeing, and this is the nature of markets, they evolve. It had moved a long way, we're now in a pause, and dollar has been strengthening. Why has it been strengthening? There is a demand for dollars globally. I've mentioned energy prices and the energy impact previously, so I think that we are going to go through episodes of dollar strength, and we're probably in that phase for the next 2 to 3 months. And again, the hawkishness from the Fed and the excess returns you can get in US dollars versus other currencies make it attractive. But I do think that it's in a longer term trend where we will see weakness. So it's going to oscillate up and down, but I do think the trend is weakness. But as I say, for the moment, dollar strength, and that's probably locked in for the next few months.
All right. Actually, dollar strength is not, or dollar strength for the next couple of months, is that what you say?
Yes.
Yeah. So it's actually not all that bad, because if you think about Asian economies, a lot of them are still export driven.
Yes, absolutely. And then, you also think about the impacts that, currencies have in inflation.
Yeah.
Is it importing inflation just through the movement in currencies? And certainly you've seen that in other parts of the world.
Yeah, exactly. So I think it's not a one-liner response to a US, whether it's strong US dollar is good or US dollar is weak is good. I think we have to look at each market and then from that context.
Yeah.
Yeah.
And also those economies that need dollars more than others. For example, India, being quite energy dependent, oil in particular, oil priced in US dollars, they are therefore a net buyer. So obviously the relationship between US dollars and Indian rupiah in this case is quite important to factor in.
Yeah, like I said, 2023, because of a lot of these macro factors are all moving at the same time and they're moving in different ways as well. Yeah. So I think at a retail, if you're an individual investor, if you try to have a very simplistic view of the market and try to time the market, so to speak, it's going to be very challenging. So
it is, and this is a new regime. We've talked about zero interest rate policy that's been in place for 10, 15 years. We're not there anymore. No. And as you say, there are lots of macro dynamics that are feeding into markets, influencing asset prices. They don't all occur at the same time or in the same direction. Certainly the way I like to think about the world is to work with our macro strategy team, who come out with phenomenal original research as far as I'm concerned, and then we embed that into our thinking by mapping macro regimes and then understanding which asset classes are likely to give the best outcome based on that theory of which regime we're in.
Exactly, and I think it's a lot of that has to do with retail investors understanding what outcomes they want to achieve rather than what markets they want to chase, what market returns they want to chase or go after.
And I think the word you use there is critical. Chasing returns. Yeah. If you're an income investor, surely what you would be looking for is to maximize the probability of meeting your income needs. Whether it is 4, 5, 6, 7%, depending on the market, depending on your specific needs. If you then also try and chase excess returns, the reality is you're going to have to add more risk into the portfolio. There is no return without risk.
Correct.
Now that's fine when markets, and beta in particular, you're riding on the wave of them going up. But we saw what happened last year, and I think there are many investors who were very disappointed with the overall performance of their portfolios because they had a lot of specific risks in there, and of course when markets turn, you follow that wave down.
Exactly. Thank you, Luke.